My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. I'll do my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. We are witnessing what I can regard only as a newfound skepticism of Cramer fave Nvidia. I'm sensing it. People are suddenly treating Nvidia like it's some kind of a parvenu, like the corporate equivalent of nouveau riche. So on a day when stocks were once again hostage to a weaker bond market, which pushed the Dow down 411 points.
That was easy.
While the S&P lost 0.74%, the Nasdaq declined 0.58%. It is worth addressing what the heck is going on with these mega cap market capitalizations that everyone's talking about, not just people involved with the stock market. Nvidia is worth $2.8 trillion, nipping at the heels of Apple, which is stalled at around $2.9 trillion. It's still fairly far behind Microsoft at $3.2 trillion. First, let's dispel with this parvenu characterization. I like to go to the source of all wisdom with this, ChatGPT itself, herself, which tells us, quote, while Nvidia's rise to prominence has been rapid compared to older technology companies, it has established a strong reputation for innovation and quality in its industry. Therefore, referring to Nvidia as a parvenu might not fully capture its established status and influence in the tech world. Woo! I knew that generative AI was smart but polite. Who would have thought? Hey, why don't we do this? Let's ask rival Anthropic's generative AI system, Claude, about this newfound wealth characterization. Well, he offers a more aggressive approach. And I quote, because the company was founded in 1993, it's a fairly mature company, especially in the technology industry, where companies can rise and fall rapidly. It initially focused on graphics processing units for gaming and professional visualization markets. However, Anthropic goes on, quote, Nvidia has seen explosive growth and emerges as a dominant force in areas like artificial intelligence, machine learning, data centers, autonomous vehicles, in addition to its traditional GPU business. This rapid ascent to power and influence in these new domains could potentially lead some to view Nvidia as a parvenu in those spaces, even as it is well-established company overall. Given the somewhat more combative, extremely wordy answer, I couldn't resist asking Claude a follow-up. Is Nvidia a member of the nouveau riche? He pondered for 2 seconds, which seemed longer than usual, and then ventured, quote, some may argue that Nvidia's recent dominance and immense wealth in emerging fields like AI and data centers represent a new money rise to power and influence in these specific domains. But overall, Nvidia's longevity, corporate structure, and industry context makes it difficult to accurately classify the company itself as nouveau riche in the traditional sense of the term. There, 2 artificial intelligence services categorically deny the pejorative characterization. Let it be fair, both platforms are built on Nvidia's chips. Yet, in one form or another, I keep hearing it, people just don't believe Nvidia belongs in the mix. Too fast, too soon. It's somehow undeserving or baffling or just plain crazy. Like these guys somehow don't earn that. They didn't earn the $2.8 trillion valuation. They stole it. I get it. Until recently, Nvidia was not in the top 5 stocks in any of the last 20 years. We tend to think that the top 5 is kind of like to use more literary explanation, Gibbsville in John O'Hara's legendary appointment in Samara, a rarefied neighborhood where anyone new simply doesn't belong. In terms of this particular neighborhood, Nvidia is real new. It wasn't one of the 5 largest companies 5 years ago, or 10 years ago, or 15 years ago, let alone 20 years ago. In the last 5 years, the largest crown title was mostly a horse race among Microsoft, Apple, Alphabet, Amazon, and Berkshire Hathaway. We periodically have a long shot come close in this run for the roses, but nothing that placed or showed, like that's horse racing terms, like Tesla temporarily sneaking in its 5th horse with $1 trillion capitalization in 2022. The tech field bet with Berkshire somehow in the mix isn't all that new. From 2005 and 2012, Exxon, of all companies, led the list. That was it. A fossil fuel company with a lot of oil in the ground waiting to be unleashed and taken to the market. In fact, you could argue that Exxon led the list of largest companies in one form or another for about a century in this country. The lead only changed 11 years ago when Apple finally surpassed Exxon in size. I remember how shocked I was that any tech company could possibly topple the company that was gradually reconsolidating John D. Rockefeller's Standard Oil empire. It seemed ridiculous. A company that made cell phones worth more than the world's #1 integrated oil. It was galling enough that Apple left over Microsoft, Walmart, Alphabet, which previously had relative lead over the handset company. But back then, we didn't really care because everybody knew Apple deserved it. We understood the business. We used the iPhone, just like we used Microsoft's Windows, just like we bought things on Amazon. Not that we knew about its rapidly growing web services business. We knew Alphabet as Google, and even an 11-year-old knew search, while YouTube seemed to be an overnight sensation. Berkshire Hathaway, let's face it, Warren Buffett, the greatest icon in finance, even as you might not know that Berkshire's an amalgam of auto insurance, fossil fuel pipes, a railroad, box of candy. Even when Tesla snuck in a few years ago, people gave it more credit than Nvidia is getting now. At the time, it felt like Tesla was well on its way to becoming the best-selling sedan in America with worldwide ambitions. But Nvidia, sure, it's been around since 1993, or Jensen Huang would have worn number 93 when he threw out that first pitch. Doesn't matter. Unlike any other company in the top 5 for more than 20 years, 2 things distinguish Nvidia. 1, hardly anybody knows if they ever used an Nvidia product, as it's really part of the hidden tech world known as the enterprise. On the consumer side, only hardcore gamers care about these chips. And 2, we know Nvidia will soon overtake Microsoft, at least if it keeps up this pace, or as ChatGPT, the spawn of Microsoft on the software side and Nvidia on the hardware side, told me today to estimate when Nvidia might surpass Microsoft as the largest company, we need to consider Nvidia's growth rate. ChatGPT goes on to say, Nvidia could potentially pass Microsoft within the next year or 2. To which I say, hold it, partner. If the stock keeps rallying at this pace, it could be the next day or 2. Hence the real conundrum we're facing. On the one hand, Nvidia's new and rich, Microsoft's older and state. We know Windows and we don't know Blackwell. Somehow it's so many, it just doesn't seem right that a company they rarely interact with could be this big. To me, it's as right as when Apple dethroned Exxon. I say all that happened is that Nvidia at the far term was nowhere to be seen, but as we got to the stretch, it made its move. It shocked us. As Evercore ISI points out, no top 5 S&P market cap name has ever had a 20% move after the earnings when the S&P was down. It just snuck in. Bottom line, is it a photo finish? No, because in the end, the race is eternal. And for all we know, Nvidia, not Apple, not Microsoft, is Secretariat, the greatest of them all. Kent in Florida. Kent.
Hi, Jim. Thanks for taking my call. I really enjoy your show.
Thank you.
Today my question's about Shopify. It's fallen about 20% since earnings release a few weeks ago. It looks like it's stabilized around 57. What would you do with Shopify?
I think you can hold on to Shopify. You know, Shopify did miss. It did have some issues. I think you actually have to wait till the next quarter to see if those issues are resolved. There was a spending issue. They didn't seem to need to spend more to get business. I do like the company very much, but I'm not going to just send you in when it's not the sector in the market that's doing well. Bill in Massachusetts. Bill.
Booyah, Jimmy Jams.
Booyah, Bill. What's up?
Hey, I had a question for you. I really would like to know if there's any more technology that you see coming out of Meta with Zuck. I'd love to know what's going on.
Yeah, I think there is. I mean, I think that they're going to be in competition in something we don't know yet. They're buying too many of the Nvidia cards for me to think they're just going to continue to be just Instagram and Facebook and WhatsApp. I think there's much more in store for us, and I think you got to stay long that stock. It is not an expensive stock. A photo finish may not be in the cards here because the race is eternal. But who knows? Maybe Nvidia is Secretariat. Oh, man, money tonight. Tech titan Salesforce reported after the bell. I got Mark Benioff fresh after the report to break down the numbers, and it does not look good. Man, is it time to dig into Chipotle with a stock split on the horizon? I'm talking menu updates, TikTok turbulence, and more with the CEO. And Cadence Design Systems has been a steady long-term winner, but can it keep climbing in this new wave of AI innovation? I'm sitting down with the CEO to learn more, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, what the heck just happened to the stock of Salesforce? That's the king of customer relations management software. After the close, Salesforce reported a genuine miss. Several key lines were weaker than expected: revenue, operating margin, current remaining performance obligations, although the earnings per share number actually came in better than expected. Making matters worse, management gave a weaker than expected sales and earnings forecast for the current quarter. That said, I'm not sure it's justified to make it a total meltdown in after-hours trading. The misses weren't that big, and there's no doubt Salesforce is throwing off a ton of cash. They even raised their full-year earnings forecast. But we're so used to having this company do the right thing that I think it just took people by surprise. Perhaps it shouldn't, because the whole enterprise software sector that belongs to seems under siege right now after what it looks to be over-earning during COVID. Earlier today, we got the chance to speak with Mark Benioff, the straight-shooting co-founder, chair, and CEO of Salesforce. Take a look. Mark, welcome back to Mad Money.
Great to see you, Jim. Thanks so much for having me, and hello from San Francisco.
Well, hello, and thank you for coming on. Look, I'm not going to dance around it. The stock is down the most I've seen your stock down in a long time. But the cash flow numbers seem strong. I'm looking at the operating cash flow. I'm also looking at the Salesforce margin. They both seem within guidance. So I'm trying to I need to rationalize why this is happening. Why have people decided that your business is definitively slowing, right now, and that things are not as good as they seem?
Look, Jim, you can't always control the buying environment, but what you can control is your cash flow and your margin. And you can see the incredible growth this quarter is amazing. I mean, these are cash flow numbers that we've just never seen before, up 39% year over year to $6.247 billion in cash flow. Incredible. And you can see the margin is up 450 basis points to 32.1%. You know, this is a huge transformation that we've gone through over the last year, and this has been an incredible moment for our company. I mean, these are cash flow numbers that are even larger than Coca-Cola.
Well, if that's the case, then revenue guidance of 920 to 925, it is indeed below the 9.34 guidance. Why is it below, given the fact what you just said?
Jim, we're holding our guidance for the year at $38 billion, which has been incredible for us. And what we see happening is not only this amazing transformation in our core financials, but also the amazing AI transformation that we're going through as well. And you'll see some incredible new customer stories that are emerging with companies who are transforming themselves using our amazing new AI, including FedEx, Air India, and even Paychex. And I'd love to talk to you about that as well.
Well, let me just, before we get to that, I want to deal with this idea that things have gotten more competitive and maybe sales elongated. Is there something that I am missing which explains why people are taking your stock down 17, 18%, when it to me looks like this is a rather just typical good Salesforce quarter?
Jim, this has been an amazing year for us. We've completely transformed the financials of the company, and you can see that we're, delivering, as I said, this incredible cash flow and margin number. So, look, I can't predict what the stock market does. You know that. Right. We've been through this how many times over a couple, I guess I've been doing this 25 years. But what I can tell you is that the most important thing remains the customer success, which is why how are we going to make these customers totally transform themselves, more profitable, better customer success using our incredible new AI technology. And that's what I'm really excited.
Okay, so let's talk about what you're doing with FedEx. Let's put it out there about why someone selected Salesforce for one of the largest transport companies in the world. Why do they need you, and what are you doing?
Well, the opportunity of FedEx is incredible, and we've, of course, worked with Fred and Raj for years, but the idea now that we can really take their business to a whole new level of profitability and productivity is amazing using Salesforce Einstein. Now, Einstein is already delivering more than 1 trillion transactions a week. But when you look at our customers overall, the power is, with this new generative AI capability, we can take the 250 petabytes of information that's stored in Salesforce and action that to create another level of capability for our customers. And with FedEx, what that means is they're able to sell services to their customers that before they had tremendous white space with. And we saw that in the quarter with an incredible delivery of the AI capability with Federal Express. And the other one that I just mentioned, Air India, this is an amazing next generation airline that has acquired all kinds of different airlines in India to create the leading airline in India. But when they did that, they had lots and lots of islands of information. But using our data cloud, they're able now to aggregate that information and using this generative AI capability to, again, deliver another level of productivity and capability. And this is the technology that I see as a catalyst for more growth with the company.
Okay, so
specifically, we saw more than 1,000 new data cloud purchases in the quarter. That's the second quarter in a row where we saw data cloud with more than 1,000 new customers each. And that is the kind of growth that we're looking for in new products and capabilities.
Okay, now you've talked about the transformation, and it is self-evidently gigantic. But do you feel the efficiency efforts are substantially complete? I know that you did cut your full-year adjusted operating margin guidance, so I would think that perhaps, given it's the margin guidance, that you're not complete and there's more work to do.
Jim, as I said, you can't always control the buying environment, but you can control your cash flow and your margins. And the growth that we've seen this year over the last 12 months in our cash flow and our margins has been just spectacular. And that's what we're going to continue to focus on. That's why we've also, we're able to deliver, incredible buyback this quarter. Of course, we've initiated our dividend as well. It's been a complete financial transformation. But not only that, it's also a complete transformation of the product line for customers, giving them this incredible new capability with artificial intelligence.
So what happened with Informatica? I know that you introduced me to them years before at Dreamforce. I know that they have some really terrific products. It just didn't fit.
Jim, we're looking constantly at every company that's out there, and unfortunately investment banks can get a little bit ahead of themselves, or maybe we make a phone call to a customer to find out, what the strategic possibilities are, or partnership possibilities are with a company, and all of a sudden we see the news stories that we're acquiring this company or that company. And look, I'm a huge believer in innovation, you know that, and I believe in it in organic innovation and inorganic innovation. It's how we've created the third largest enterprise software company in the world. So I can't address specific rumors about any particular, M&A opportunity. But what I can tell you is that, we love that company. It's a great company. It's always been one of my favorite companies. And, when we look to have greater partnerships with them, I cannot, comment on whatever the rumor or speculation is.
People want me to ask you about HubSpot and Alphabet or you. And again, to me, HubSpot's another great company. It's kind of a mini Salesforce. But I don't necessarily regard them as someone who is nipping at your business right now.
These are great customers of ours, Google, HubSpot. I get back to our customer success. What is it that's making Salesforce successful today? And you can look at, another company that I think both of us love so much, CrowdStrike. We had an incredible transaction the quarter, completely transforming the company in sales and service, helping them to build new products. Again, using AI, helping to keep their costs down while delivering these incredible new capabilities.
So what I'm hearing is that, yes, you can't control the stock, but the environment is not so bad. You're not giving me that, look, the environment's gotten weaker, it's gotten tougher in Europe, it's gotten tougher in Asia. I'm not hearing that from you.
Jim, you can't control the buying environment. The reality is you're going to have heterogeneous buying environments. It's going to happen, and we're in this post-pandemic reality where the buying environment has been, and we've talked about this now for a few quarters, been very measured for enterprise software companies, not just a company like Salesforce, but many companies. So what are we going to focus on? We're going to focus on improving our cash flow and our margins. Well, look at those numbers, Jim.
No,
those
the numbers
are awesome numbers.
The numbers say to me that if the stock's at 230, why don't I? If I were you, I'd just stand there. I'd stand there at 230. I can't control the stock price, but I can control my buying of my buyback.
Yes, and we're going to focus on our customer success and these great companies like, FedEx or Air India or a CrowdStrike or even like Paychex is another unbelievable story where we completely transformed the company this year. The technology that's happening right now is awesome. So for CEOs, our opportunity is to go in and continue to show them the incredible opportunities that are at hand and deliver that and show them what they can do in this incredible new world that we're all in now.
But what did happen to enterprise software that we've decided it just doesn't have the, let's say it doesn't have the moxie that engineering software does right now?
Well, I don't think that that's it at all, Jim. I've said it a number of times over the last few quarters, and I think it's a little bit hard to understand that, we went through the pandemic, and during the pandemic, enterprise software surged, and companies, aggressively bought enterprise software and put in all kinds of next generation infrastructure. And in this post-pandemic world, they've really worked to, I think, absorb a lot of that technology that they've put in. And while that's happening, you're also going through this AI kind of renaissance that's happening. So those things have to be rationalized for these companies. You have to say, you look at our numbers, we still sold a massive amount of software in the quarter. It was unbelievable how many deals we did. I mean, our deals over $1 million, Jim, were at record levels. So we're still selling massive amounts of capability, and we have incredible new products like Data Cloud. We are delivering against benchmarks.
You
that
are. I would love
high.
to think that my questions are an abstraction, and what matters is a single source of truth that you're telling me about how the company's doing. I'm trying to rationalize the stock price, which is my department, with the selling of enterprise software, which is your department. And right now, my department is trouncing your department, and that's why I'm asking these tough questions. Not because I'm saying, you know what, Mark, it's great to see you. It is great to see you, but now at least we understand.
My department is getting the cash flow to move, getting the margins to move, and also delivering the next generation of innovation, making our customers successful. That's what I always am focused on. That's what we focused on for 25 years.
And that's exactly what you should be focused on. That's exactly what you should be focused on. I want to thank Mark Benioff, co-founder, chairman, CEO of Salesforce, who does not shy away from anything, and basically he's telling you, listen, this is business. And there we go. Mad Money's back after the break.
Coming up, want to split a burrito? Cramer chats with Chipotle, and there's plenty on the menu. Next.
Like I mentioned last night, companies with high dollar share prices are finally embracing the virtues of the stock split. Take Cramer fave Chipotle, which reported another spectacular quarter over a month ago. Just as important, 2 months ago, the board approved a 50-for-1 split, which will make this $3,000 plus stock a lot more accessible, as I know you want. With the stock currently down more than 5% from its all-time high earlier this month, I think this could be a really good entry point for a stock that never seems to quit. Don't take it from me. Let's speak to Brian Niccol. He's the chairman and CEO of Chipotle. You get a better read. This is ready. Mr. Welcome back to Mad Money.
Yeah, Jim, great to be here.
So, Brian, we are stuck in some situation where I read a restaurant news story. 80% of America thinks that fast food is now a luxury. What the heck has happened here?
Look, I definitely think consumers are getting to be more thoughtful about where they want to spend their money when it comes time to eating out. That's why at Chipotle we've always been focused on great ingredients, great culinary, terrific customization, and obviously we always talk about great throughput. And I think when we stay focused on those things, people feel good about spending their $10, $15 with Chipotle.
But that's what's so amazing to me. It's got to be the health and the food and the people, or else you would be way outside the realm of what people can afford in this country now.
Yeah, that's right. I mean, we've spent a lot of time making sure that the bowls, the burritos, obviously they're big. You get exactly what you want. Whatever diet you may have, right. Keto, Whole30, whatever it is, however you want to eat, vegetarian, you can get great culinary always from Chipotle. And our people do a great job, I think, of serving it up every time, every single day.
Now, you mentioned big. Obviously, we've got this TikTok troubles, I would say, where some people are filming and some people are saying, hey, listen, give me, I want something big. What leverage does a customer have over a very seasoned worker who wants to do the right thing for the company and right thing for the customer?
Yeah, I mean, look, the whole thing is kind of crazy to me.
It is.
We've always said we want to give people great portions. We want to give them what they want. And our team members.
You've not shrunk the portions.
No, we never have. Like from the beginning of time with Chipotle, I think there were billboards that said burritos as big as your head. Like that's never changed. And our teams, they are focused on giving people what they want. So the whole thing's a little silly. It actually kind of really bums me out when people, frankly, do this videoing thing because it's like, it's a little rude to our team members. And our team members, their desire is to give our customer a great experience. Like that's what they want to do. There's nothing better than our team members giving people the bowl or the burrito that they want. And so, hopefully that's what people are getting. I know that's what our teams want to provide.
Okay, well, I finished half my chicken al pastor, saved the rest for dinner today. But other people are saying, well, listen, there's less chicken al pastor. And I said, no, that can't be. It's the same amount. And then I started thinking, maybe if you order out, that you're not looking in the eye of the worker, and the worker does. I'm trying to figure it out, Brian.
I don't know. I mean, if you're in our restaurant in person, you know how this goes, Jim. All you got to do is look at our team member, and if you're like, hey, can I get a little more rice? Right. You just give them a little nod, and more than likely, the guys give you a little more rice.
That's absolutely
the chicken.
True.
They want to give them a great portion of chicken. I, like you, love the chicken al pastor. Whenever I go into the restaurant, I see people getting great portions. I see a lot of happy people.
Would you ever do it all you can eat like they did the shrimp at Red Lobster?
No.
You don't want to go bankrupt?
We're not going. We're not going all you can eat. We are going great ingredients, great culinary, great bowls.
Okay, so everyone knows the food tastes great, and we're willing to pay up. Obviously, even in California, they pay. What I think people don't know is the engine. And I know in your conference call you talked about an outfit in Boston that did so many more when they did for that key 15 minutes. And then right before we started filming, you talked about another outfit doing 15 minutes. It's that crunch time that really determines how well you guys do.
Yeah, look, I had the opportunity before we sat down here to visit a handful of restaurants, and it was just really exciting to see. You know, as a company, we're focused on throughput.
Right.
And I had a couple managers share with us, you know, in 15 minutes, they're doing 50 transactions. 55 transactions, 60 transactions.
You got to explain how hard that is.
This is what it's so.
Because in 15 minutes, at my restaurant, if I did 10.
Well, look, this is why it's so important that our teams are staffed, deployed correctly. They do the prep in advance. They're ready to go, because then they're able to give the customer exactly what they want and move them through really quickly. And you know, it's really fun to see when you're doing 250 transactions in an hour. The teams are getting bonuses. They're fired up. It's really fun to see.
Well, how about this stock split? What does it mean? Do you hear people buzzing about it when you're at the stores?
Yeah, you know, what is fun to see is people have the ability to buy Chipotle shares, but it's, you know, they're buying pieces, right? Yeah. And so there's a lot more excitement when you can buy a whole share or get a couple shares. And it's great to see, because some folks, I mean, literally, that have owned our stock and have been a manager for many years, they're cashing it in to buy homes. And that's what makes this place
That's America. That's the old special. America, maybe. I don't know.
That's the Chipotle that we're trying to create.
Yeah, and that's what matters.
Yeah.
Now, let me ask you, 7,000, that's just a huge burden upon you. But you think that that's what you obviously need that many, right?
Well, look, I think there is the demand for it.
Right.
And, you know, today we have 3,500 restaurants. We definitely see a path to 7,000. I'm guessing as we get closer to that, we might see a path that goes beyond that, just in the United States.
And you want that many great people, because that's the hardest thing everyone tells me. Trying to get that many great leaders, that many linebackers, that many captains.
You know, what was really awesome, Jim, is we just had our all manager conference. We brought in every restaurant general manager, above store leader, and some apprentices that are getting close to being promoted, and anybody that worked at our company for more than 20 years. So everybody came together, and I'll tell you what, the energy and the excitement of developing other people is genuine. I might have mentioned this to you. In the back of our restaurants, we have a career roadmap.
Yes, this is great. This is a great
story. I think, really powerful, because people that join our company may come in first working on the grill, but when they walk into the back of the restaurant and do training, they'll see this career roadmap. And in some of the restaurants, the general manager or the field leader has put pictures of people that have left the restaurant and moved on to these jobs of general manager, field leader, team director. And it's almost kind of like their own family tree of development. And it's really exciting. It's really powerful, because when people see others that have succeeded like that, they want to be a part of it.
Well, this, like my executive producer had the burrito today, Regina Gilgan. It's possible that the person who made the burrito could end up making a huge amount of money in stock in Chipotle, and maybe at another Chipotle, maybe that one. This happens still.
This happens all the time, and it's really fun to be a part of it and celebrate it, without a doubt.
Well, that's what we should do. We should celebrate it and celebrate you guys, celebrate your team, celebrate Jack Hartung, because this is who's the CFO, because this is what it's supposed to be about. Thank you.
I agree.
Thank you very much. That's Brian Nicholas, the chairman and CEO of Chipotle, and get the stock before it splits. Mint Money's back after the break.
Coming up, in league with Nvidia, this AI play has lapped the market. Can our next guest get your motor running? Stick with Cramer.
Everybody's focused on Nvidia as the embodiment of artificial intelligence, but there are plenty of other companies with a meaningful AI angle. Take Cadence Design Systems, which makes software that helps semiconductor companies design their chips, along with helping to design other types of electronics, including advanced automotive systems and even new drugs. Most important for the moment, their platform helps create the most advanced, leading-edge chips that are crucial to artificial intelligence. Now, Cadence has been a phenomenal long-term performer. Stock's up 43% since we last spoke to the CEO a year ago. But in recent months, it's kind of pulled back from its highs. And when Cadence last reported in late April, it delivered a mixed set of numbers. They beat expectations across the board in the first quarter, only slightly though. But the stock dipped, but it's hung in since then. Don't take it from me. Let's dig deeper with Dr. Anirudh Devgan. And Anirudh is the president and CEO of Cadence Design Systems. Dr. Devgan, welcome back to Mad Money.
Jim, great to be here.
I'm very excited to see you because I think people have to recognize that as great as Nvidia is, what would Nvidia be if it just sent its plans to Taiwan Semiconductor? It wouldn't happen, would it?
Nvidia is a remarkable company and a great partner of Cadence. And you know, these chips, like the latest chip Nvidia announced is Blackwell, has like 200 billion transistors. So this is some of the most complicated things, you know, humans have designed. But these chips have to be designed by software. They can't be designed, you know, manually. So that's the software we make and products to design these chips. And we have had a long partnership with Nvidia, you know, over 20 years. And it has really picked up over the last several years, given all the AI kind of acceleration. And we also announced a new product in April, you know, like Blackwell is like 200 billion transistors. But our new product that helps design, you know, Blackwell and Hopper and these chips now can design 5 times bigger chips, up to 1 trillion transistors. That's several generations of, you know, these next generation chips.
You make the point over and over again. It's someone who, like me, I'm liberal arts major. We say, oh, wait a second. You say they're too small to do it by hand. So they're done mathematically. Now, wait a second. How do you do something mathematically?
Well, it's a combination of computer science and math, you know, applied to physics. You know, that's what we call computational software, is these optimization algorithms, simulation algorithms that actually physically realize the idea that an engineer has, a designer has, into, you know, what a transistors or chip would look like. So it's a lot of deep kind of numerical analysis, Boolean analysis, all this algebra and calculus in there.
Okay, but we know from the great companies of many years that we know enterprise software.
Yeah.
This is not enterprise software. You're doing engineering software, quite a different art form.
Absolutely, and we have big investment in R&D. So, you know, at Cadence we have 11,000 people, 10,000 are engineer and computer scientists. And half of
There's
them,
a good ratio.
Yeah, half of them have advanced degrees. And we also invest, you know, 35 to 40% of revenue in R&D. So it's a very R&D intensive activity, and that's what gives us a moat and long-term differentiation.
All right, now you've been emphasizing many different kinds of uses, but this automotive intrigues me because it would seem that that's where that's an autonomous machine. It's not a car, and maybe you can tell us what that really means for the future.
Absolutely. So I think there's a lot of talk of semiconductors going from 500 billion to 1 trillion, okay? And there are 2 big drivers of that. One of them is data center AI, you know, and the other one is automotive. And data center, you know, AI, you know, we do a lot in that, you know, your viewers know about this. But automotive is equally exciting. Now, it's a little bit delayed, you know, AI, data center AI will happen first, and then automotive always takes a little longer. But in the next 5 to 7 years, there will be a massive automotive investment because right now each car has about $400 of semiconductors, and that's projected to go to 2,000 to 4,000 per car, and there are about 100 million cars sold in a year. So that's $100 billion of semiconductor content driven by, you know, autonomous systems, you know, self-driving, ADAS, infotainment. So the whole electrification and autonomous driving of cars will be a big boom for the industry, just like data center AI is.
Okay, so now I also want to know about what you're doing in terms of platformization. I know you're doing semis, but the platform is something that only you can do.
Exactly. So what we are trying, you know, what I think is going to happen in all industries, and especially we have been doing it for a while, is what we call a 3-layer cake, which is a platform, 3-layer stack. So the bottom layer is accelerated compute. You know, used to be CPU, now is GPU, FPGA, custom silicon. That's the bottom layer. The middle layer is physical intelligence. You know, these are things based on actual physics and chemistry and biology of the systems. You know, and the top layer is AI, which is data intelligence and orchestration. So these 3 things have to be done together. And the reason I call it a cake is when you eat a cake, you consume the 3 layers together. So one application of that is chip design, right? Like we talked about, whether it is for data center like with Nvidia or for cars. But there are other applications like for aerospace, for digital biology. All these things will have to be revolutionized. Because when we do chip design, we do 100% of it in the computer virtually. But when they design planes and cars, only 20% is simulated. The rest is done by physical test. And when we do drug discovery, only 1% is simulated. The rest is done by physical test. So all these industries have to also apply computer science and math and AI to really revolutionize. And I think that will happen in the next 5 years.
And then to go full circle, obviously you're creating what's the equivalent of a digital twin of what the company might want, in this case, Palladium, because they can't just design it without a vessel. And it's an intelligent vessel, and that's your vessel.
Exactly. So this AI, digital twin, and accelerated computing all together enables a lot of use cases. Of course, chip design is a huge one, and that's our core business. And there will be more and more chips consumed in the next 5-10 years. But there are other applications, like you mentioned, cars, planes, and biology.
Well, look, I think that where you want to be right now is engineering software, not enterprise software, as we saw earlier this evening. But I want to thank you so much for coming on. Anirudh Devgan is the president and CEO of Cadence Design Systems. Guys, this is such an important company in terms of all the things we talk about. It's behind the scenes, but you need to know it. It's a great company. We have money's back there for the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. Some of the lightning round, Chris, remember that's where we're told. Right, saving the stars. Bye. Self-centered. The call start right. I know my step for this. Play this up. And then the lightning round is over. Are you ready, Skeet? That time of the lightning round comes. We'll start with Barry in California. Barry.
Hey, Jimmy, I love you, baby. How you doing?
Thank you. I'm doing well. How about you?
I'm doing great. Jimmy, this Monday morning, I woke up and I had an epiphany. I sold my Disney stock, 100 shares of it. I sold it, and I did something I hope I don't regret. I bought Nvidia. I used it all to buy Nvidia. Am I crazy, Jimmy?
No one's ever crazy to buy Nvidia. Now, we do know from my friend Scotty Wapner that Nelson Peltz has cleared out of, Trian has cleared out of Disney. I got to tell you, I'm in. I think he cleared out much higher. I have a big meeting tomorrow at 12 o'clock, and I'm going to tell you why I think Disney is not something you should run away from. Not telling you to sell the Nvidia to get into Disney, but I don't care that Nelson's out. Because I think that at these prices, Nelson would probably join me in wanting to be in the situation. Let's go to Arshan in California. Arshan.
Can you hear me?
Yeah, you sound good. It's Jim.
Okay, I'll cut it straight to it. What do you think about MODG, Callaway?
I keep thinking it's going to move up, and you know what? I've decided just better play it with Dix. Dix has got golf. Dix is better run. I'm going with Dix. Let's go to Walter in New Jersey. Walter.
Booyah, Jim. I've been a member of your investing club for a long time. And
all right, tomorrow, 12 o'clock meeting. I'm counting on you. What's going on?
There you go. About a year ago, one of the money managers on CNBC, they all were giving their idea of what the best stock was. This lady chose CCI. It was trading at 110. It went down to 84. You can barely get back up to 110 again. It used to be $211 stock. There you go.
All right.
What's wrong with the company? Is it management? Is it what? They have a good dividend. What am I not getting?
And this is Crown. Okay, here's the problem. There's no growth, and the company has been incredibly poorly managed. So I'm going to have to say stay away. I don't want you near that stock. Let's go to Todd in Florida. Todd.
Hey, Jim, I'm calling about OKLO, and as a former nuclear reactor operator, I have concerns about an operatorless nuclear reactor. But if it works, I think it'd be great.
I actually like to see some humans there. I think that is a kind of technology that requires humans. But I'm doing a GE, the Vernova. That's the way to play these things. That's the best one. And you know what? It's just better that they got small form reactor, and I think they're going to make good of that. Let's go to Jeff in California. Jeff.
Hey, Jimmy Chill. I really want to buy this stock called AppLovin. AppLovin, baby.
Well, AppLovin had a great quarter, and people are AppLovin, and I'm not going to fight you on it. It was great, and I don't like enterprise software. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, 3 retailers of a different stripe. And all of them winners? Cramer explains the big moves. Next.
different retailers put up numbers today that were nothing short of extraordinary. So we got to drill down to see how they made you so much money, given the prevailing weakness that we see in the malls and shopping centers across America. We're talking about the stocks of pet provider Chewy, up 27% today, Dick's Sporting Goods, up 16%, and Abercrombie & Fitch, up 24%. You don't get those kinds of moves without a takeover or a monster upside surprise. What the heck's going on here? Now, Dick's and Abercrombie have been clear winners all year. In fact, Dick's Sporting Goods is now up almost 54% for 2024, while Abercrombie's more than double. And that's after the stock went up 285% last year. Chewy's still down 9% for the year, but it's made a remarkable comeback from its April lows. How did it happen? First, in the case of Abercrombie and Dick's, we have first-class management teams that have created amazing places to shop. Both Abercrombie and Hollister, their other big brand, are key destinations at the mall. Now, some may say that the mall is dead, along with everything in it. But maybe you just need to make your stores more attractive. Both millennials and Gen Zers are drawn to this company's stores. And that's how Abercrombie could earn $2.14 per share. Street was only looking for $1.76. That's how you get 21% same-store sales growth. Street was looking for 10.2%. That's extraordinary. Younger people are also drawn to the online options. This company has a very powerful omni-channel business, and it's got novelty. The CEO, Fran Horowitz, recognized, for instance, that weddings are no longer one-day events, but multiple days. So she has a wedding store that's catering to that. Listen to this. She says, quote, the launch of the wedding shop has clearly exceeded our expectations from the beginning, and the wedding season hasn't even technically started yet, end quote. How about this? Right, this is a remarkable story of reinvention. These giant House of Sport locations are drawing crowds, as are the 50,000 square foot stores, and a story of technology. They have a remarkable omni-channel business, and they've invested a huge amount of money in it. Plus, don't forget about the incredible, and I mean incredible, and I think also underutilized Game Changer app, which allows you to live stream sporting events. I would have given anything to see my daughter play goalie in the field hockey championship game, but I was stuck at the office with the market falling apart, a mistake that I deeply regret to this day. With Game Changer, at least I could have watched it from anywhere. Chewy's a comeback story. The company had positioned itself as the ultimate online pet store with its popular auto shipping option ensuring its relevance even against Amazon. Stocks soared during the pandemic, along with pet adoption. But then adoption fell off, and so did Chewy's business. Now the adoption versus relinquished numbers, yes, that's an actual metric, have improved, and Chewy's ready for it, having started its own veterinary clinics to reduce pet care costs. Anyone with a pet knows how ridiculously expensive vets are. Chewy's attempting to bring down these costs. What stands out to me with all three of these success stories? Execution. There are plenty of apparel chains out there that are doing terribly, and they blame their woes on the consumer. Maybe they don't understand fresh and new like Abercrombie. Anyone in the millennial or Gen Z cohort knows that weddings have become multi-day affairs, but who else has capitalized off it? Dick's has embraced differentiated product assortments and deep engagement with its own brands, as well as popular third-party ones like On and Hoka, and of course Nike. Their bigger stores are a blast. It's something anyone can tell you who's been to them. Chewy used the post-pandemic drought to get better. Gross margins have expanded. I sense the growth spurt coming from CEO Sumit Singh that he predicted it when he came on the show back on December 14th, and now it's happening. What a comeback. It doesn't hurt that each of these establishments has a tremendous balance sheet, which allows them to spend heavily on the best technology. That's essential if you're trying to fend off Amazon, isn't it? Chewy spent so much money, they announced a $500 million buyback. Three retailers bucking the trend. Three that join Williams-Sonoma and yes, Ralph Lauren in overcoming the weakness we keep hearing about. Maybe you just have to be different. Maybe you have to be exciting and enjoyable to survive and thrive. To which I think most of us would say, hey, no kidding. But it turns out to be a lot harder than people think. No wonder so many retailers go under. They just can't compete with these great operators. And maybe, just maybe, they never will. I like to say there's always a bull market somewhere. I promise to find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.